Hello and good afternoon. My name is Christine Lee with Calco's Credit Union, and I work in the Department of Community Relations. And as you may know, Calcos is the longest serving financial institution in San Diego. And the credit union was started by teachers in 1929. And since the beginning, our vision has been to foster a culture of service and commitment to our community. We are enthusiastic about providing valuable resources and tools to our members to help achieve financial prosperity. And to that end, I'm excited to welcome you today to our financial wellness webinar on the topic of the importance of financial planning. And just before we dive in, I'd like to mention to everyone that you will all be placed on mute, but if you do have questions, please use the Q&A function at the bottom of your screen, and we will be sure to answer those. All of the presentation specific questions will be addressed by Raymond, our facilitator, and any Calco specific questions, please place those in the Q&A as well. And either myself or my colleague, Karen Burke Acosta, our lead business development officer and senior mortgage loan officer, will be sure to address those. We will be recording today's session, so if you would like to go back and review the information, you can do so by visiting the YouTube channel that we have dedicated for your City of San Diego staff. So, all right, so let's get to the important and valuable information that we're going to cover today. I am pleased to introduce Raymond Arroyo, who is today's presenter. Raymond Arroyo is a financial advisor for California Coast Financial Services. Ray holds the designation of Certified Financial Planner, which demonstrates his competency and commitment to his clients in the areas of investment management, retirement planning, and insurance solutions. Ray has helped clients from various backgrounds, including business owners, military personnel, attorneys, doctors, engineers, teachers, and folks of various levels of net worth. Ray helps clients to strike a balance between investment growth, wealth preservation, and risk management, as well as income solutions when retired. When Ray is not working, he's spending time with his wife and 2 children hiking, fishing, boating, as well as going to concerts, sporting events, and wineries. All right, Raymond, the floor is yours.
Thank you, Christine. Welcome everyone to the Importance of Financial Planning. Quick question. Has anyone ever taken a boat ride to Catalina Island or a cruise anywhere? Well, there's a map or a captain that has map and coordinates, and he has directions, and he has a plan of how he's going to arrive at the destination. And he doesn't just allow the waves of the ocean to, just take the boat where they want to go. So that's kind of similar to planning your financial future. If it's retirement planning, we don't want the waves of life just to put us in a spot when we're 65 years old. We want to have a plan so that we know where we're going and what we want to accomplish, and so we arrive at that point, not just by happen chance. So that's what we're going to go over today, the importance of financial planning. And let's get started. So financial planning is, it's a step-by-step approach to meet one's life's goals. It acts as a guide as you go through life's journeys. Helps you keep control of your income, expenses, investments, so that you can achieve those goals, whether it's retirement or college savings for children, for example. There are a number of different ways to benefit, including increasing your savings, having a better standard of living, being prepared for emergencies, and just being able to sleep at night and have that peace of mind when you're just on a daily basis. There are a few different stages for financial planning. Some folks may start out be just starting out and maybe in your 20s or early 30s, and some of those things that you want to take care of might be creating an emergency fund or life insurance. And then you start to build your wealth, and how do we maximize your contributions to 401ks? Where's the best place to, or 403bs, different types of retirement accounts, where's the best place to place those investments? And then once you start nearing retirement, which may be mid 50s, You want to make sure that we adjust those investments to reflect the stage of life that you're entering. And obviously, once you get into retirement, there's a number of different things that you can do to be sure that you're accomplishing your goals that you started planning for when you're in your starting out stages. So your starting out stage is going to be a lot of times someone graduates from college. You're maybe in your 20s or early 30s, and maybe you're starting a family. So what's important there is to have an emergency fund. In case someone gets laid off of work, emergency funds should sometimes be about 6 months of reserves of your income, so that if someone gets laid off work or there's an emergency, that you have money to pay for those things. Or maybe you're saving for a down payment on a house. You could be looking at fixing up your credit. Maybe you opened up some credit cards in college that didn't work out too best and damage your credit a little bit, and you maybe need a little bit of credit repair to save to establish that credit so that you can qualify for a loan to buy a house. Other things to plan for during this stage might also be life insurance. If there's a couple that has a child together, and if someone were to, unexpectedly pass away, how are you able to pay your expenses? Or if you have a child, how are you able to support that child? So those are some important things in those early stages of starting out for to get a hold of during that planning process. So I'll pause right there with that starting out phase. Anyone in a starting out phase or have questions related to that I can address? I'll wait for 20 seconds or so. If someone wants to type in a question, Christina can look at those and then let me know if there's any questions that come up.
So Raymond, we did have an initial question while people are typing new ones. They are asking if Lori Russell, she's asking if the PowerPoint slides will be available for anyone to access later if they'd like.
I believe these will be available. I don't know for sure though. So this presentation is really more general on the importance of financial planning. I think what would benefit Lori the most is, depending on what stage she's in, to take the appropriate actions to contact someone who can kind of walk her through that process, and she'll get the most value out of that. Because as you can see with this first slide here, it's pretty general, and a lot of the slides in this particular presentation are general. So again, really having something specific for her is really going to help the most. And in reality is all these slides are important, but the most important thing is to take action on wherever stage that you're at to really start implementing something.
Great, thank you, Raymond. And what we'll do is we'll put the contact information in the chat for the group to access. And we don't have any more questions, Raymond, as well.
Okay. So the next stage is in the building wealth stage. This could be, maybe somewhere in the 40s for some folks. Maybe you already purchased a house and now you want to prioritize where your savings will go into, or where your investments will go into, and which investments have, there's different types of investments that some have more tax advantages than others. And so it's important to start in the right spots, because it could be a little disadvantageous to make those adjustments later on, although it could be a benefit. And then monitoring your portfolio. And so this stage would be where you're taking the correct risk in your investments, so that your investments can grow according to what you're comfortable with. And this also is also including in this is ensuring your health and your life insurance. And that's really all your different types of insurance for life insurance, and your auto, and your homeowners, and your health insurance. Sometimes it's not just about finding the lowest cost insurance. It's sometimes more important about finding the right amount of coverage and balancing that with the cost of insurance. So, if someone's looking to prepare, financially for this stage of life, that's something that we can help with too. So folks in your late 30s, 40s, this is probably your section where if you have any questions, maybe this might be a good time to ask. So I'll pause for about 20 seconds to see if any questions come up. Okay, so no questions. So once you're near retirement, this could be 50s, late 50s. Really, it's about fine-tuning, meeting with an investment professional to adjust your asset allocation, maybe doing a quick analysis on Social Security and when to start taking that, as long as when to start taking income from your retirement assets, such as your 401k and any type of 403bs or retirement accounts. Estate planning. This is referring to if you were to pass away, how do your assets get transferred on to your spouse or the next generation if someone has children. So this is kind of like, if you're in your 50s, this is like getting a checkup on your health, right? You go to your doc, you don't go your whole life without getting a checkup on your health and then get a checkup when you're 65 on your health to say, hey doc, am I okay? And find out all your blood work is off. The same thing for your investments. You may have had an investment portfolio that worked for you for the last 20 years, but without making sure that you're invested properly, a major drop in the stock market, which we have seen, which happens maybe about every 4 or 5 years, could have a very huge negative impact on your investments and on your retirement plan. So making sure that your investments are properly allocated to the right type of investments. Maybe it's time to start protecting some of those investments now that they've grown over the last 20 or 30 years. And if someone's looking at their healthcare costs, how does Medicare and all that come into play once you get into your 60s, up until 65. So all these different types of assets can contribute to your income, and how do they all correlate once you start taking one versus the other? This is extremely, this is like crunch time, one of the most important times to really focus. You may have only 5 or 10 years left until retirement. Making the appropriate changes could make a huge positive impact on your retirement moving forward. Does anyone have questions in this? Anyone in this stage of their retirement or in this stage of their planning? I'll pause for 20 seconds. Christine, any questions here?
Raymond, no questions yet. Give it a couple more seconds to see if anything pops up here. I think we're good for now.
So once you're in retirement, it's really bringing all those assets together to create an income strategy and your retirement budget, and setting up trusts and such for your legacy. I would assume there probably be no questions here, because if you're in retirement, you're probably not working, but addressing all those questions when it comes to choosing your income sources and when to take them are extremely important, as well as setting up your trusts for your real estate, your property and those types of assets that don't have beneficiary accounts. A lot of your 401ks, IRAs, those types of accounts you can set up with beneficiaries so that they do go directly to children, or if you want to have them go into a trust, for example. Does anyone have any questions about this stage? And some folks actually might be helping their parents that are maybe in their, I have a lot of clients that they may be in their 40s and 50s, where they're helping folks who are in their 60s, 70s, and 80s, where their folks are needing help with their investments, because they maybe have seen some losses, or they maybe have some funds that are just sitting in a savings account, not earning interest, and maybe they want to try to earn some interest on those accounts. So I have had a lot of folks that are younger that help their parents in this stage. And if you are in that situation, we can have a joint meeting with your parents as well as yourselves to make sure that your parents are getting some good advice, that they are making good decisions as they enter into their later stages of life. Anyone have questions here?
No questions yet, Raymond.
Okay. So again, the importance of financial planning shouldn't be ignored. It's not just about increasing your savings and reducing your expenses. It's more than that. It includes achieving those goals of creating wealth, retirement planning, education for your children, finding the proper investments that minimize taxation. And again, we don't want to let the waves of life dictate where we end up when we're ready to retire in our 60s. We want to have a plan to accomplish that, and that's something that we can help with, to help you understand your current financial plan, write down your goals, looking at your different investment options, and then implementing those plans, and then monitoring it. And we meet with our clients on an annual basis to make sure that we're following that plan, and those plans could change over time. Divorces could happen. We help clients with folks who go through divorce. We help folks that receive inheritances, and folks who change jobs. So there's a number of things that we do with inherited IRAs. We help with 401k and different types of retirement plan rollovers. Just a ton of different things that we can help with separation of assets if someone does go through a divorce. And so when you're in your different stages of wealth, if you're in the starting out phase where maybe you need to fix your credit and establish a budget, we have a service called Financial Fitness, and you can email them at financialfitness@calcoastcu.org. It's again, that email is financialfitness@calcoastcu.org. That's for folks that are starting out that maybe need help rebuilding their credit, or how to get qualified for a loan, as well as creating a budget. But once you enter the building your wealth stage, you're in retirement, and in retirement, that's where my specialty lies, and I can help you with that, whether it's managing different investments or creating a plan to increase your wealth. I can help with that. You can call me direct, and we can chat and find out if it makes sense for us to meet, and we can meet at one of the credit union branches. My phone number there is 858-322-1384, or you can email me to just get a conversation started or schedule an appointment at rarroyo@calcoastfinancialservices.org. And that's about all I have to cover today. Are there any questions out there?
Thank you so much, Raymond. What we're going to do is I'm going to check actually we do. We have one question that came in. Here we go. The market is down right now. Does it make sense to wait for it to go back up before rolling over a 401k, or does it not matter in the end?
So every situation is a little bit different. So if your money is inside your 401k, most likely it's invested in the stock market. So when money is inside a 401k, it's typically passively managed. So that means that there's not someone that's actively changing those investments for you to optimize the performance over time. So if you want to still be invested in the stock market and you do a rollover, we could do a rollover into an IRA. And once you're in that IRA, we can put you into potentially an actively managed portfolio that can adjust based off of how the stock market moves, how the economy moves, and it really depends on someone's age. So if the money's in the 401k and inside a money market, which if you did not move the money into the money market, most likely it's not, and it's probably invested in the stock market. So the stock market is down still this year, although July had its first positive year or first positive month since December, which was really great to see. Although there's a lot of negative news out there on social media, and there are a lot of positive factors that say that the economy is still doing okay and that we can still have a recovery. So one of the important rules of investing is to invest when the market's down, and another rule is don't sell when the market's down. So and then a third rule is it's always best to don't try to time the market, because even the most successful investors don't time the market. It's really more about time in the market. So if you have any type of longer term investment horizon, maybe close to 10 years or longer, definitely want to stay invested. If someone's getting close to retirement, then it could be completely different. And because we've seen a couple drops of 50%, in 2000, we saw a 50% drop approximately, as well as 2008. And then in COVID, we saw a 35% drop, and then we saw a 25% drop this year. So if someone's right on the edge of retirement, then we would look at maybe some potentially different things. But if someone has 5 or 10 years longer, then we probably look at staying invested in the market. But again, maybe not leaving the money in the 401k and doing a rollover. There are pros and cons. There are different costs that apply. So it would be best to maybe schedule a phone call with me to at least have an initial conversation, and then see if it makes sense to meet after that. Hope that was helpful.
Great, thank you, Raymond. Okay, we have another question. Is it always advisable to roll over a traditional IRA into a Roth IRA, or is it ever a disadvantage to do that?
So there's a process called Roth conversion, and that's where you convert a traditional IRA into a Roth IRA. When you do that, you have to pay taxes on the entire amount for the traditional IRA. It's not always advisable to do that because there's funds that you have to you have to pay taxes to the IRS. That's just the rule. Now, once the money's in the Roth IRA for 5 years and it grows, you don't have to pay tax on that in the future, but you're taking a hit by paying taxes up front. So I can help you with an analysis to see if a Roth conversion is an appropriate action for you. Everyone's a little bit different. So sometimes we can do the conversion over a few different years, over a few years. That might make sense. You don't have to pay all the taxes at once. But everyone's situation is different. So I would definitely suggest we do an analysis of that Roth conversion to see if it makes sense.
Okay, Raymond, there's a follow-up. So is it better then to wait until retirement to do a conversion when income would be less?
Yes, potentially. That's potentially when we do the Roth conversions, is when someone's in retirement. But I would say if you're having questions about a conversion, and if your motivation was to save money on taxes in the future, or now, you may have other questions that are linked to that. And I think a phone call would definitely be at least a starting point to get that conversation started and get some, because it's hard to give any specific advice if I don't know someone's bigger picture financially.
Okay, great. Thank you for that, answering that follow-up question. And I think it looks like we've answered all of the questions, Raymond.
Okay.
So
I
thank you
actually
so
have
much.
hold on a second. I actually have a question around
Sure. Perfect.
IRA. On a Roth IRA. So Raymond, would you be able to, instead of actually having a traditional IRA to where you have to deal with pre-taxed money and paying fees, if you actually had some post-tax money laying around, is there a minimum to putting into a Roth IRA? Because I like the idea of not having to pay taxes on the gains, but if you start it with post-tax money, then you don't have to pay taxes either way, correct?
That's correct. So you can start a Roth IRA. There are limitations for income. There are limitations for if you already put money into a traditional IRA. So the maximum that you can put in 1 year in a Roth IRA, if you're under age 50, is 6,000. It goes up a little if you're over the age of 50. And as far as a minimum goes, you can start off with small amounts, like, under $1,000 if you wanted to.
Okay, but if you wanted to start one off with like 7,000 or 8,000, you would be able to do that.
The most you could put in 1 year is 6,000.
Over 50?
If you're over 50, you can put in 7,000.
7,000. Okay.
And that's every year. It goes up and changes a little bit every year.
Okay, but you have to keep it in for, what is it, 7 years or 5 years? 5 years. So you keep it in for 5 years. And that's on the stock market, right?
No, that's a IRS rule.
Oh, no, but I mean, is the Roth IRA on stocks?
You can invest. So when someone has an IRA, doesn't matter which type of IRA it is, you can invest in a number of different things. And one of those investments can be stocks, bonds, mutual funds inside of an IRA. But you can also have, other things inside there as well.
Okay. I'm curious about that. Yeah, because I've been wanting to start a Roth myself.
Yeah, we can do that.
Okay, perfect.
So,
is there any other questions? And does anybody have any questions for the credit union in particular?
Yeah, Karen, there's a couple of more questions for Raymond.
Okay.
Okay, Raymond, is it a good idea to roll over a 401k into an IRA, traditional or Roth, or any disadvantages?
So, so in a 401k, if you're not working with the employer anymore, you can do a rollover. Most 401ks, if you're still working at the employer, then you cannot do a 401k rollover. So that wouldn't be even an option for you unless you're over the age of 59 and a half. Then some of those 401k plans, but not all of them, do have an option that allow you to do an IRA or to do a rollover into an IRA. So when you do a rollover into an IRA, so when your money's sitting inside a 401k, you're limited on your investment choices. So you may have anywhere from 20 to 50 different investment options inside your 401k. Well, inside an IRA with California Coast Financial Services, for example, we're partnered with an investment brokerage called Securities America and Priority Financial Group, where we can get access to thousands of different investments. And with that, what that means to you is we can find the best investments that are out there, not just the best investments inside your 401k. And then of all those investments inside the IRA that we put you into, as the years go by, if one investment is not performing very well, we can switch it out for another investment for you, and find another great investment out of all the thousands of options that we have. Inside the 401k, you'll have lower fees. And inside the IRA, you'll typically have higher fees because it's an actively managed portfolio. There's more professionals that are looking after and watching those investments for you, because you'll probably notice that in the 401k, you may or may not have had someone reach out to you and make recommendations on where you can place your investments or make adjustments. So you probably don't get that inside your 401k. With the IRA rollover, we would be able to do that for you. So that's why, so there are more parties involved in an IRA rollover, where we would be looking more parties involved to look after your investments and make sure that they're the best investments moving forward for you and that are appropriate to you. As opposed to inside your 401k, there's probably that's probably not happening. The 401k company could be a good company, but you're just limited to the options that are inside there. So again, the IRA fees will typically be more, but you get a lot more and potentially have better performance over time. Now, whether it goes into an IRA, when you do a rollover, automatically goes to a traditional IRA, then you can, if you wanted to do a Roth conversion after that, then that's something that is an option as well.
Great, thank you so much, Raymond. And then the next question is, with the current inflation rates around 8%, how do we invest in an emergency fund to not lose money? I can't think of any savings account options that give close to an 8% return.
All right, so those are kind of a good question. Those are kind of two different topics though. So emergency fund isn't necessarily intended to outpace inflation, okay? Your emergency fund is just money that you have set on the side if you need to buy a new car or get some repairs done to your car or get a roof replaced or fixing your house, or your AC goes out in Southern California in the summertime. That's an emergency. We got to get that fixed, and that's not cheap. So AC heat, so emergencies like that, or someone gets laid off of work, you're going to need that money to pay just your monthly expenses. Or if you're married and your spouse passes away, that could be money to pay the expenses as well. So your emergency fund isn't necessarily meant to outpace inflation. And while inflation's been 8% approximately 8% over the last 12 or so months, inflation average has been about maybe 3% or so. But emergency fund is to pay for expenses now. The reason, and that's a good question about inflation, because you do want to outpace inflation. So if someone does have their investments sitting inside a savings account that's earning, less than 3%, then that could be definitely a concern, because if on average inflation's been, let's just say 4%, which I don't know if it's even that high on average since this last year, but let's say inflation's been 4% and you're in a savings account of 1%, or someone puts their money in the money market of their 401k or their IRA sitting in a money market and it's not earning anything, then yeah, that money's shrinking. but this is money that you're going to use for your retirement later on. So any retirement money, we definitely need to outpace inflation. And so we want to make sure that it's invested properly. But the emergency fund is not intended to outpace inflation. That's just there for, once you build that up to maybe 4 to 6 months, then we can start investing that money back into your retirement and make sure that we're keeping pace or outpacing inflation there.
Great answer. Thank you, Raymond. And it looks like we answered all of the questions. So thank you so much again, Raymond. And I want to give Karen an opportunity to make any announcements or share anything that she'd like to regarding CalCoast.
Thanks, Christine. Hello, everybody. I'm Karen. I actually handle the city of San Diego. So I've attached my virtual business card in the chat. If you guys would like to give me a call, I can help answer any questions that you guys may have or follow-up questions to this topic or beyond. I also heard, I was going to mention that we do have, if you haven't taken advantage of, our 5% CD. That does pay 5%. It doesn't pay 8%, but it does pay 5%, and it's a short-term CD. You can lock that up for 5 months and make a little over $100 on $5,000 if that is something that interests you. It's a little better than what you would get in a savings account or a money market. So that just right off the bat is something that as a city employee, you would be able to take advantage of. It's a one-time deal. You only get due at one time. So if you haven't taken advantage of that, you can certainly call me and I can advise you further, make that happen for you. If you're interested in joining the credit union and you're not a member, I can help you with that. I can, pretty much help you with any aspects in regards to the credit union. So my contact information is there. Please feel free to give me a call and we can take it from there. That's
Perfect.
it.
Thank you so much, Karen.
You're welcome.
And before we conclude, I'd like to remind everyone that we'll be continuing our monthly webinar series next month. That date is Wednesday, September 21st at noon. The topic will be cybersecurity awareness, keeping your financial data safe. This is an excellent topic and very timely as internet crime has been on the rise over the pandemic. So you don't want to miss this next webinar coming in September. And I would also like to remind you that we have a free financial fitness service. As Raymond mentioned, you can email financialfitness@calcoastcu.org and someone will respond to you in a few business days to get you all set up with a meeting. And don't forget that you can access this presentation in the coming days via the CalCoast City of San Diego YouTube page. If you have any questions, actually, we had one question pop up. So before I officially end it, Raymond,
Okay.
I'm gonna have you
Great.
there. This might be a Karen question. What's the minimum amount on the 5% CD?
The minimum is 500 and the max is 5,000. It's called Take 5. We take 5, so it's all 5. It's 5 months, 5%, either $500 or 5,000 or anything in between that.
Great.
I always say if you've got the 5,000 laying around, that's not making you much money in a savings account. Roll it into this. It's short time. It's only 5 months, a year away from your money, and it'll make you a little over $100. I mean, I think it's like $122, something like that on 5,000. So you can kind of do the math, but it's better than 10-15 cents a month, that you're making on your savings account. So.
Great, thank you. Good timing, Mary Chris, on that question. But if anyone comes up with any other questions, the contact information for Karen is in the chat field. Please grab it before we log off. But any questions can also be brought to our branches, or you can give us a call or message us on social media, and we will be sure to get back to you through those channels. And we just thank you so much for joining us today. And we hope you enjoy the rest of your week, and we'll see you again next month.